All right, good afternoon, everybody. We're going to go ahead and get started. My name is Tyler Parks. I'm the Director of Government Relations here at the Tax Foundation. So quickly, the Tax Foundation is a nonprofit dedicated to studying tax policy at the state, federal, and global levels. But obviously today, we're going to talk about the federal tax policy conversation. But any questions about that, please feel free to reach out to me. I'll have my cards, and I'll be here at the end. So the Tax Foundation also has a tax model that can model federal tax policy, and Garrett works on that model. So if you have any questions or would like to see policies modeled, please feel free to reach out to us. We're happy to get that done for you. So the Tax Foundation believes that the tax code should be stable, simple, transparent, and neutral. And so I think, as I'm sure many of you are here for the expiration of the TCJA, 2017 Tax Act moved the tax code in the direction of those four principles in some ways, and then to represent a departure from those principles in other ways. So this expiration of the TCJA at the end of this year will represent a chance for Congress to try and move the tax code towards these principles of sound tax policy. So I'm going to set the stage a little bit here for Garrett before we get started on the meat of today's presentation on the individual tax code. So tax policy can solve some key issues, and it can also create issues for Congress. So outline a few of those for you right here. So if the Tax Cuts and Jobs Act is allowed to expire at the end of this year, 62% of taxpayers will see higher taxes annually. So to put this into context, a family of four earning the median household income of around $80,000 will see nearly a $1,700 tax increase each year. And if you're curious what that would mean for your districts or your constituents, the Tax Foundation has a congressional district map that models what would happen if this tax cut is allowed to expire. If you want to get even more granular, we also have a tax calculator that can plug in some simplified examples of the tax code and shows what the change in that tax situation would be. We also are going to experience low growth. The CBO projects that over the next decade, we're going to be growing under 2%, whereas in the previous decade, we grew at 2.3%. We also have an emerging debt crisis. We know that in 2060, if Congress does nothing, we will see a debt to GDP ratio of almost 186%. But if we fully extend the TCJA at a cost of $4.5 trillion over the next 10 years, it'll be above 200% of debt to GDP. Tax complexity is also a common problem. I'm sure many of you have run into this as you filed your own taxes. The TCJA saved about $50 billion in tax filing costs. Well, that's a significant step in the right direction. Americans still spend $500 billion a year, according to the Tax Foundation and IRS data, complying with the tax code. So what is this class going to do, and how are we going to try to attempt to solve some of these problems and both the tax code itself and the economy writ large? So we hope that what you'll take away from this is to understand the trade-offs of tax policy. There are essentially four dials that we can attempt to change with tax code. We can figure out how much money the government wants to raise. We can figure out who pays the tax, how much we can grow the economy, and then this fourth stool of how simple can we make the tax code. There's no perfect policy for all four of these. And it's up to you and your bosses to decide which dial to turn which way. So a little bit of housekeeping before I hand things off to Garrett. Obviously, this session is being recorded, but we will turn that recording off for the Q&A section after the end of class to respect y'all's privacy. And you have an assessment in your hand, and if you don't, please feel free to grab one. And you will turn that in at the end. So to get the TFU certificate, you have to attend 2 classes. And get a passing grade on the assessment, but we don't intend this assessment to be difficult, but just to make sure y'all picked up some of the key concepts from the class. But if you have questions about the assessment, ask me or Garrett, and we're happy to help. And then obviously there's food in the back, so please grab some before you leave, and also grab some for your office as you're leaving. So I'll introduce Garrett Watson. So Garrett's our Director of Policy Analysis at the Tax Foundation. Garrett writes on federal and state tax policy, and he also leads our modeling team here at the Tax Foundation. He's been featured in the Associated Press, Washington Post, all on tax policy. So Garrett's a well-known entity in the tax world. So Garrett, with that, I'll hand things off to you, and we can get started.
Awesome. Thanks, Tyler. Thanks, everyone, for coming out today for our first session of TFU. So today we're going to cover the individual tax code. As you know, we'll have several sessions this week. This one will be focused on the individual tax code. We'll then move into business taxes as well as international tax policy over the next couple of days to give you a well-rounded understanding both of how the federal tax code works now, what are the major areas of policy interest and engagement that many of you are already working on, of course, on the Hill, and how does this all tie into the broader, more near-term policy debates that we're already underway and that we're going to continue to have through much of this year. So we're going to get started with that now. Clicker's a little delayed. All right, so what are we going to cover today? We have a few things we're going to cover. A lot of it is going to be an overview of the individual income tax code. The income tax code, of course, is quite complex under current law. There's a lot of moving parts. For many of you, of course, we have a very sort of mixed audience of folks who have potentially just entered the space with tax in your portfolio. Maybe tax is an adjacent area of interest. For some of you, of course, this is all maybe a review of content you may be familiar with. You may pick up something new, something you haven't considered before. And we're going to try to get everyone up to speed on a baseline of how the individual tax code works, what are the tax policy trade-offs, and what are the major numbers and factors to consider for this year's policy debate. And that will include not just the, the calculations and structure of the individual income tax, but also the major worker and family tax credits that are provided in the income tax code, which also have their own set of policy issues and trade-offs that will be critical for this year's debate and debates moving forward. We'll also cover a little bit about what are known as pass-through businesses, like sole props, S-corps, partnerships, because we often, a lot of the tax that is paid for those businesses comes from the individual income tax. We'll also cover that in a little more detail tomorrow in our next session on business taxation more broadly, but I'll give some context on that today. And then we will tie this all into the expiring individual provisions of the 2017 tax law, some of the major numbers we've come out with on this for individual provisions that are expiring, some of the policy trade-offs and discussions that are being had and reform options in what is already a debate that is heavily underway. So as Tyler mentioned, we do have, from the taxation's perspective, some principles of tax policy that we try to examine through our research and engagement and writing, many of which you're probably already very familiar with if you've engaged in our work, and many of which, of course, are nonpartisan, are rooted in academic research and an understanding of what makes a good structure of a tax code, and that is simplicity, neutrality, transparency, and stability. One thing you'll notice here, just to point out, is there's very little, if anything, about rates in this. So this is about the structure of the tax code, how we make it stable and simple and transparent for taxpayers, make it easy for the government to collect revenue, make it a stable source of revenue for the federal government. And that can be done irrespective of policy disagreements about how much revenue we collect, what the tax rates are. You can actually be on diametrically opposed positions on that. What is an important and key question, to be clear, but the structure matters just as much and sometimes even more from the perspective of taxpayer experience and economic growth than rates. And you'll see that theme in our work at Tax Foundation and our discussions here today. I also meant to mention at the outset, if there's any clarifying questions or quick things people want to raise while I'm speaking, feel free. We are going to have that dedicated Q&A at the end. But if there's anything that's unclear, feel free to raise your hand and we'll address it. So we're now going to move, before getting into the structure of the tax code and some of the items there, we're going to move a little bit into personal income, because I think it's important from an income tax perspective to understand what are we taxing when we think about income. What is income? And that's actually a trickier question than it may otherwise appear. Right? We think about our income. It's helpful to look at what are the sources of individual income in the United States that are subject to tax, as well as, of course, some of the nuances of how we think about income from an economic or tax perspective. To start on the more, I think, straightforward side of it, as you can see in the visual here, of course, employee wages and salaries, folks who are on W-2 income that are subject to reporting to the IRS, subject to ordinary income tax rates, is the bulk of income for most Americans in the U.S. That, in some ways, is actually the more straightforward aspect of income in the U.S., both from understanding what that income is if you're a W-2 employee and in terms of withholding, right? A lot of this is done on a taxpayer's behalf by one's employer, as well as, of course, working with the IRS with returns to reconcile your withholding with your final tax paid to get to either a refund or to pay in a balance owed. And then that trend remains fairly stable and has remained stable over time, though as you can see, there is a big dispersion by income. So higher earners have a smaller portion of their income earned as wages and salaries. Instead, business income, investment income, other sources of income become much more predominant. And that's where, in the tax code, is a common source of complexity in terms of determining and making sure that we're having proper reporting and in some cases withholding of business and investment income. We're going to get into capital gains a little bit too, which is structurally a little bit different than other sources of income, which many of you may already know, and it's a review, but it's an important point that capital gains and business income is treated a little bit differently, particularly for those pass-through owners in the form of capital gains and dividends. This is important, I think, just because the experience of the tax code very much differs depending on your income level and your sources of income. And of course, it's also important to point out that retirement income is very much important, right? And that includes private savings from retirement vehicles like 401ks and IRAs. It includes pensions that are defined benefit, as well as, of course, Social Security benefits, which are, under current law, partially subject to income taxation at the federal level. And that, of course, is an important form of savings across the board for most Americans. The other point I want to make, of course, is, and this gets wonky, so I'll keep it at a high level unless folks want to get more into the debate, is a key debate within tax policy wonk land, and it reverberates onto the Hill, is how do we think about income? What is income? How do we define the income tax base? That's actually the source of a lot of tax policy disagreements and debates, right? What type of income is a particular source of income is also complicated. To take one example that may stand out as very salient for y'all is the treatment of carried interest. I'm not going to get into what carried interest is or the debate surrounding it, but carried interest, the debate is fundamentally about what kind of income is it? Is it more like labor income that should be taxed like an employee wage or a salary? Or is it more like investment income and should be subject to capital gains tax rates? That's actually a fundamental policy question, and it comes down to how you think about different sources of income that we tax differently depending on the type of income that it is. So that's just an important point to think about when you see some of these debates. So getting into it a little bit more on the actual structure of the individual income tax. At one point in prior sessions, we actually had a 1040, and surprise, surprise, a lot of people don't really have a lot of interest in working through a 1040 line by line. We do have here an example, a lot of numbers here. I'm going to work through some of the major items here just to point to that matter for policy debates. We do have a lot of resources, of course, separately on our website if you're interested in learning more on the mechanics. And of course, a lot of us are familiar with 1040s, having filled them out either directly or via software that helps us. But there's a few things here to point out. One is, when it comes to defining income, a key line is your adjusted gross income, or AGI. You've probably seen this a lot in various policy debates as it relates to means testing or phase outs of various benefits. And so it is an important indicator of one's income. But AGI actually is not fully capturing everyone's economic income, going back to that definition debate. Why is that? Because we actually have several exclusions in the income tax code for benefits or various types of remuneration that will be considered income in an economic sense. A big one, of course, that most of us either have or are very familiar with is the exclusion for employer-sponsored health insurance, which has a monetary value but is not included for purposes of taxation in your adjusted gross income. So even this AGI number that we use, that is a fairly broad measure of one's income, does have a policy design and consideration to exclude certain types of income that economists would think is important. So that's just one example. The other major thing just to point to, again, this is a review for a lot of us, but does make a big impact on the complexity of the tax code, is the standard deduction, which is the next sort of major line item. Once you get to your adjusted gross income, you're throwing in your W-2 wages, your salaries, your business income, et cetera, that's included in there. You then have the choice to either take the standard deduction or to itemize. And that was a big one, of course, in the 2017 tax law, where we doubled relative to the prior law the amount of the standard deduction. Under current law this year, it's set at $15,000 for single filers, double that to $30,000 for joint filers. So folks who are going to have itemized deductions that are expected to be less than that will just take that standard deduction and can avoid all of the rules and receipts and other requirements needed to comply with making sure that you're following the rules for itemization. And that's had some beneficial effects, right? Reducing the number of itemizers from roughly a third in tax year 2017 down to approximately 9% today. And that's partly because of that expansion in the standard deduction. So that's a big choice for taxpayers because they still have to determine, okay, let's take my itemized deductions, right? My charitable deductions, for example, my home mortgage interest deductions, all of these have various rules and limitations. You, of course, have to have the receipts in various different forms. If you've been on the edge of itemizing in the past or know someone who has, you would know that that can be a much more involved process. That's the source of complexity and can be time-consuming for taxpayers. And that's one way, at least one way, far from perfect, that we try to relieve this for taxpayers who are not close to itemizing. They can just take that standard deduction and move on. There's enough of other complicated things we're going to get into in a minute they have to deal with. That's one less thing they have to deal with. So once you do that, once you reduce your standard deduction, your itemized deductions, there's many of which we can talk about. Some major ones, of course, I've already mentioned. There's also, of course, the deduction for state and local tax payments for income taxes and property taxes, or in some cases, sales taxes that are paid to states and localities. You can deduct that from your federal return. That's another itemized deduction currently subject to that $10,000 cap. That's one rule among many governing itemized deductions. Once you decide that and take those, you get to your taxable income. And that's actually the income that is subject to tax, right? So we've already gone through several stages of reducing the income tax base to get to your taxable income, and that's when we apply the tax rates, right, to actually get to the amount of tax owed. I'll get to the schedule here in a minute just as a reminder for everyone. And that's when you get to your tax liability before credits, and that's when you can apply the credits, which are dollar for dollar reduction in your actual tax liability. As a recap, and we'll remind you again in a minute here, there's a difference between a tax credit and a deduction. A deduction reduces the amount of taxable income that you'll be subject to, but does not change your tax liability dollar for dollar. So the actual benefit is the change in tax liability times the tax rate for a deduction. So there's a difference there. That's important. Sometimes even in debates on the Hill, for folks who know this subject matter, it's very easy to mix up deductions and credits. So it's just a good thing to remember. So moving on here to the actual tax schedule, right? Again, another reminder, but a common, I think, misconception among the general public that's good to just be aware of is a lot of folks think that this schedule applies to all income when you hit the income thresholds, right? So if you have taxable income at, say, $23,850 as a married filer, some folks think that you actually pay that new 12% rate above that income threshold on all of your income. And so you can see why that would be a big problem, right? Folks are thinking they actually learn less net of their tax if that were true. That actually can be true in some cases in some as it relates to benefits cliffs, but that's a totally different sort of issue. When it comes to the actual schedule, they are applied on the margin, right? They're applied to the extra dollar that's earned above the threshold. So it does, of course, create potential disincentives, right, to work or to invest because the returns are lower, for sure. But it doesn't mean that on net they end up with lower income than they otherwise would. I think it's just an important point to remind ourselves. And the other important point here is we have done a fairly good job from a policy perspective at ensuring that for most taxpayers, these thresholds are doubled for married filers. There's an important concept as another recap in the tax code of marriage penalties and bonuses, which is the idea that if you were to take two single filers with a certain amount of tax liability that they have the same income, ideally, there really isn't a good reason why, if they were to get married, that they would have more than exactly double their tax liability. They earn the same amount of income, right? If they earn less or more, you end up with what is known a penalty or a bonus, and those exist throughout the tax code. There's actually a lot more marriage bonuses than penalties, believe it or not, which makes it tricky to solve this problem, and it's baked into the broader structure of the individual income tax code. But for this purpose, you can see, if you're interested in running through the numbers, most of these brackets are exactly doubled, which is good, with the exception being the top, the 35 and 37% brackets, which are not. That has been a source of a big priority for policymakers. Just worth noting, though, and that general idea of marriage penalties and bonuses. All right, so that's the very quick recap of the ordinary income tax side. That includes, of course, short-term capital gains and a lot of dividends. So it makes sense to now move to capital gains. How are they a little bit different? How are they treated differently? What's the different schedule, mechanics for capital gains? So capital gains income is effectively, one big difference is that it's taxed when realized. So there's a difference, at least we treat both in terms of our tax code, if not economically. There's a difference between earning income, say, from a W-2 job and seeing paper appreciation on, say, a stock or a bond that you may owe. Or for a lot of Americans, of course, it's the value of their house, where through independent valuation or through appraisal or through, of course, looking at public equities markets for liquid stocks, you can see that the value of your stock has risen, right? We consider that a change in our net worth, right? And generally is a good thing. But for a lot of folks, of course, the intuition which follows in our policymaking is that that paper valuation is different from cash in hand that's liquid and available to pay tax. And so under our system, capital gains, that valuation between the difference between the current value of the stock and its basis, or in this case, the price you bought it for, that would be your gain. You only pay tax on that when it is realized or when it is sold in most cases. And so that's a big difference. Why does that matter? Well, that means that taxpayers have more planning behavior, more planning opportunities. That's because they can choose when to sell their capital gains to realize the net gain, or to take a loss when you sell an asset for less than you bought it for. And so that's big effects, right? In terms of revenue collection, people are going to time their gains to minimize their tax liability. They might try to take losses when the market is down. They may engage what is known as tax loss harvesting, which is a form of that, if they have a taxable account where they can take advantage. So that's really important from a policymaking perspective, because when you change these tax rates or when you change the structure, that could have very big impacts on taxpayer behavior and what is known as realization behavior, right? How folks are going to sell and the timing of when they're going to sell their assets. So there is, of course, a separate set of rates and brackets for capital gains, known as long-term capital gains and qualified dividends. Generally, you have to hold a capital gain for a year or longer in the United States to be subject to this. And those rates, you'll notice, are lower, right? The top rate is 20% at the highest amount. For a lot of Americans, it's actually 0%, either because they're below the income threshold or because they have a lot of capital gains in tax advantage accounts, right? And so they get another tax advantage there. We can get more into detail on tax advantage accounts in the Q&A if folks are interested. One other caveat, of course, is there are additional taxes that are sometimes applied here, including the what is known as the net investment tax, 3.8% on certain passive investment income above $200,000. So there's some additional taxes here, but it is very much lower than ordinary income tax rates. There's a couple of things here, right? One is this is a source of major policy disagreement. It has been historically about where to put capital gains rates. They have come down over the last 25 years in particular. The early 2000s, we saw some cuts there. There's a couple of reasons why this is structured this way. One is there is a concern about realization behavior, that if the rate is too high, folks may decide to hold off and not sell their gains, and so you don't get that revenue. There's also, of course, more distortions economically, because people will be stuck in what is known as the lock-in effect. So if you have a house, right, or if your family has a house, and they're stuck at the very low pandemic interest rates, sub 3%, the lock-in effect from that channel very intimately, right? Because if they're having to refinance at 7% or move houses at 7%, they're more likely to stay. Similar effect here as the rates rise. So that's one reason why we've thought that maybe lower rates are beneficial. The other is some of this tax that you're actually paying on a capital gain is indeed the value of inflation, right? Assets go up in value, not just because of real factors like the economy is doing better, right? Profits are higher, but also because inflation, the price level has gone up, and you're taxing some of that. And so you can remove some of that by lowering the rate. Other countries sometimes exempt capital gains, like a portion of capital gains as well. It's another way of going about it. In this country, we typically just tax them at lower rates. There's also this broader argument that, hey, this is a good way to encourage capital formation and investment. Again, subject to a lot of empirical debate amongst economists, a lot of political debate here. But that's the other important, of course, point is there's, on the other side of things, a lot of incentives potentially for income shifting, right? If you can reclassify your income as capital gains or investment income subject to this tax rate, that is beneficial, rather more beneficial than having it subject to ordinary tax rates. So treating income with different tax rates, you can make a case for that, but there are trade-offs. And in this case, planning avoidance, that's one big one to think about. All right, so I'm going to move into tax credits here, and this is a very interesting area as well. Again, another recap here is that tax credits are reducing your tax liability dollar for dollar. Another term you often hear is the difference between refundable and non-refundable tax credits. This is the idea that the credits are reducing your tax liability dollar for dollar, but what if you hit zero? a lot of Americans have little or no income tax liability. If they're in the low 10% tax bracket and have the standard deduction, right, that can often bring them to a low amount of taxable income and tax liability. And we have a lot of programs, both the two biggest of which we'll talk about here is the child tax credit and the earned income tax credit, that are really motivated to help both workers, low-income workers, and families with children. And so we're baking into, into the tax code part of our broad, social insurance or welfare or social safety net for those types of households. But you're limited if you get down to zero. So a non-refundable tax credit, the idea is you can reduce your tax liability to zero, but no further. If you have any other benefit of the credit, you generally lose it. You're generally not allowed to carry forward credits in the same way as other tax provisions. There may be some exceptions, but generally not. A refundable credit, by contrast, you can actually go negative. So, if you have $1,500 of tax liability and you have a $2,000 child tax credit, right, you can reduce your tax liability to zero with that $1,500 and then get a $500 check from the Internal Revenue Service, effectively paying out to those families and households the balance of that credit. So that when you hear about debates on refundability, that's what we're talking about, and it's an important point, intentional design for the earned income credit and the child tax credit for it to be refundable, because a lot of these low-income families, again, don't have a lot of liability to offset as it is. Another important point, as you can see in this visual, it's sort of striking, is that credits have become, particularly these, the earned income credit, the child tax credit. There are, of course, many other credits in the tax code for businesses and other uses, but those two combined, in particular, have been going up in value quite a bit in real terms over the last, since about 1990. In the 90s, of course, we had a big debate. A lot of us weren't here then on the Hill, but where we were trying to create incentives for work, incentives for families with children to help them, to support them, and that's when we saw both the expansion of the earned income credit, which dates back to the 70s, and the reinvigoration and growth of the child credit as well. And you can see that in this chart. Of course, one thing that's fighting against this is that while the earned income credit and several of these credits that we'll talk about here in a minute are indexed for inflation, not all of it is. So the biggest of which, of course, is the child credit itself is not indexed for inflation. So notably, since its last expansion to $2,000 beginning in 2018, its real value has declined since then. So that's an important caveat. So why does this all matter, in particular for taxpayers? Well, as I think we're all familiar with here, we've gone through sort of a wild ride on the child credit in particular. This is just a review of all of the design parameters, starting in just from ARPA, which was in 2021, greatly expanded the child credit temporarily for 1 year. And then we went back to TCJA policy. And then starting next year, we go back to prior policy as of 2017. And so, and this isn't even getting to all the other changes that have happened, going back to TCJA and before that. And so it's just to demonstrate the differences in the policy design. And of course, we think about this from a wonk perspective or a staffer perspective, but from an American household perspective, this is complicated for us. Can you imagine being the average household trying to keep track of all of this and seeing where this is going? There's been a lot of instability, to go back to that key principle, when it comes to the child credit in the last decade, reflecting, of course, underlying debates about the role of the credit and what the credit's trying to do. A couple of things here. There's a lot of numbers here. Happy to get into this in detail. A couple of things to mention. One, of course, is there's a central debate about the role of the credit, right? The credit has been viewed as a way to reduce tax liability. In some spaces, it's seen as a way to offset payroll taxes paid, which we'll get into in a minute, for families with children. And of course, it has also been viewed as a key way to try to reduce child poverty, right? To expand the amount of support the federal government is giving for children, to help with an emerging fertility crisis potentially. And that comes in tension with the other goal of the credit, which is to encourage families with children to work as part of the sort of pairing it with the earned income credit. And so we do have rules related to the amount of income you need to earn. We have a phase-in rule here. We have limits on the amount of refundability for the credit. And that all relates back to trying to create an incentive to work in the credit, and trying to ensure that there's not, that you don't have that disincentive. And by contrast, the ARPA credit was really trying to maximize the value of that credit, trying to remove some of those, because of course that brings down the amount of the value of the credit for very low income or $0 income families, right, who in this calculation end up with no credit. So some of this is disagreement over what the role of the credit is in the code, and will of course inform debates moving forward. In the short term, of course, the big thing, as you'll see here in the chart, is the value of the credit is going to go down quite a bit starting at the beginning of next year. And there's a bipartisan interest in potentially reviving at least the current design of the credit. There have been some interest in, on a bipartisan basis, to more incrementally reform the credit, to do something in between these two designs, right? You saw this in the bipartisan tax bill last year, to, going back to my point on indexation, to index the credit for inflation at least, to reduce some of that penalty that's happened because of inflation post-pandemic, as well as some other changes to help poor families with children. Still very much subject to a lot of disagreement on a policy basis, which has sort of slowed down and stopped the policymaking on this topic. So really important point. Another interesting stat, 96% of families with children received the credit in 2021. And so that shows you just how much, with the ARPA credit in particular, what's at stake here, the number of children who get this credit one way or the other. In addition, of course, to the child credit, we have the earned income credit, which is a pretty important one. A couple points here. This is primarily a credit used to encourage to work, to reward work. That was a big part of this. And it is substantial, right? For lower income families, particularly with multiple children, it is substantial as a portion of their income. So we're talking about, sometimes five-figure amounts here, which really help supplement, make a difference for families with children mathematically in terms of their finances. But as you can see, there are some challenges here, and I'll talk about both the earned credit and the child credit in the interest of time. On the complexity. I think this is one area where rationalization and simplification may be in order, could be done on a bipartisan basis. One is, you can see that in the earned income credit, we have a mix of a child credit and a worker credit. So we're sort of mixing and matching these, right, where both credits have work and children components to it. That makes it complicated for everyone involved. It makes it complicated for us, makes it complicated for families. That's one source of complexity. The other is in a lot of the details here, particularly on definitions for qualifying children, they can actually differ depending on the credit that we're talking about. There are obviously a lot of, we might consider them edge cases, but they're actually not all that uncommon, right, as it relates to children with shared custody, right, or families that have complicated custody arrangements. That can get very complicated, where people end up misclaiming the credit and end up having to get into a tax battle with the IRS, right? We have a lot of overpayments, many of which are not deliberate fraud, but actually the result of the complications here of folks trying to claim the credit in good faith, but making mistakes. And so there's opportunities here to potentially reform, simplify these credits. We've done some research on this, and we'll continue to engage on this moving forward. This isn't as changing as much with the expiration of the TCJA, but still an opportunity for reform here moving forward. So just to diverge here in the interest of time, go ahead.
Those complications, how different are they between the child tax credit and the EITC?
That's a good question. My understanding, and I have to remember on the some of the GAO data, is that the overpayment rates, which I think is a good way of showing sort of the results of the complication, generally speaking, are a bit higher for the earned income credit. You can see for all the calculations maybe why, right? Especially when it's varying the way it is by the number of children, which may be a little simpler for the CTC. But generally speaking, they both, they're far from, I think, depending on how it's framed, right? There's a lot of other areas where there's fraud and overpayments. It's not the only place in the tax code, but it is an area where I think it's a very salient and clear example of the design sort of playing into why we have overpayments. And so I think that's like an important point. Trying to see how we can simplify the design. In addition to the administration, right? There's obviously an enforcement and administrability part of this this conversation. I've generally seen it as a split, with a little more on the earned income credit side being the source of complexity. So back to the payroll tax. I did want to mention this just because I think we'd be remiss to talk about individual taxation without mentioning the payroll tax. As you can see from this visual, most Americans actually pay more in payroll tax than income tax. And that's because payroll taxes are generally applied on your W-2 or self-employment earnings, with very few, if any, deductions or exemptions or exclusions. In some cases, we do exclude certain types of economic income from payroll tax, right? Again, going back to employer-sponsored insurance or certain fringe benefits, we typically don't apply payroll tax to those benefits, for example. But generally speaking, for any amount of earned income, for W-2 income, self-employment income, anything that's considered labor income, we try to apply this payroll tax, which is made up of two key components. This can get a little confusing if you're not in this space or know this well, so I'll try to go through it as simply as I can. The first is, of course, the Social Security payroll tax, which is, you may have heard it as well as the OASDI or FICA tax, which goes to both Social Security, retirement benefits, as well as financing the disability system. And that's applied at 12.4% all in on each employee or on self-employment wages from up to $176,100. So that's where you hear this Social Security cap, where that tax is only applied to those earnings. Anything above it is the 12.4% is not subjected to that income. So of course, this goes to the Social Security Trust Fund for retirement as well as for the disability program. It is split in terms of the administration between the employers at 6.2, employees at 6.2. A really important economic point is generally most economists see this as in terms of the incidence, which is who actually pays the economic burden of the tax. There's a difference between who's actually paying it administratively or in statute and who actually bears the tax economically. In this case, most economists find that even though it's split in statute and applied in statute between employers and employees, that employees bear the full burden of the payroll tax through reduced wages. And so you have that split, and then the Medicare tax is another major component at 2.9%, again split 1.45% between employer and employee. That has no cap and it's applied to all self-employment and wage income, and that's of course financing Medicare. One important point, of course, is this is a little, I don't know if it's actually all that different from income taxes, I guess, because you are getting some services, but some folks view these a little differently in that you are paying in payroll tax for Social Security benefits that folks will be getting later, right? So there is this, even though we don't actually pair the payments to people's benefits, right? There's no account, a Garrett Watson account where I'm paying in payroll tax benefit for those benefits later on. But people often think about it that way, as trying to connect the payroll taxes paid for Social Security and Medicare with the benefits they receive later. And of course, as many of you may be familiar, a lot of those benefits actually exceed the amount of taxes paid, and that's a big source of our insolvency problem. Of course, need to mention that, right? Currently, we are collecting less payroll tax than benefits we are sending out for Medicare and Social Security. We do have trust fund amounts that are on the accounting books that effectively are being drained down, that are owed from the rest of the budget. That will run out and will become legally insolvent. I think it's 2033 for Social Security and 2036 for Medicare. Depends whether or not you're including the disability program. I know those numbers have shifted a little bit in the last 6 to 9 months, but quickly becoming, an emerging crisis, as everyone is familiar with, as part of the broader debt problem that Tyler mentioned. I'm going to quickly, in the interest of time, just mention non-corporate income tax. I think it's an important point. We're talking about individual taxes. We'll get into this in a lot more detail tomorrow with my colleague Erica York, who's going to go into business taxation in a lot of detail. But the big point is we do remit tax for pass-through businesses on individual returns. So they effectively pass the tax, the income through to individual returns, and we tax them there. So that's true of simple firms like sole props, partnerships, small mom and pop shops you're familiar with, right? But it also applies to very big firms, right? So the big 4 accounting firms, a lot of law firms, medical practices, very large, complicated businesses also often are structured as pass-through firms, and of course they're taking their profits and remitting them to partners or all the owners where they are then subject to tax. I raise that point because sometimes people conflate pass-through business with small business. It's not quite, there's a little bit of nuance here, right? There are big pass-through firms in the United States, and there are actually small C Corps. And so generally speaking, a lot of small businesses are pass-throughs, but you can mix and match them. There are several TCJA provisions here, the biggest of which is the 199A deduction, where you get a 20% deduction for qualified business income. That's a big provision that's expiring as part of the 2017 tax law at the end of this year. And it's meant to try to both encourage investment for pass-throughs and try to equalize the tax treatment of pass-throughs with C Corps that have that 21% permanent rate that we brought it down to as part of the 2017 tax law. So we can talk more about that in the Q&A if people are interested. We'll get more into business taxation tomorrow as well. All right, so getting to TCJA here for the balance of the time. Wanted to get a little bit in the sort of the major issues we're facing here, some of the numbers that we've produced, both for motivation and various options that Congress has to deal with this. It, of course, is the single largest issue that has been looming over us for the last few years and is now here, where we saw one of the biggest reforms to the tax code since 1986 in December of 2017. Of course, subject to a lot of political and policy and academic research and debate over the last 8 years on the law, but it was a major reform that did, for the individual tax code, temporarily change wide swaths of it, and of course cut taxes for most taxpayers, though there remains discussion about the distributional effects, which we'll get into here in a second, with the motivation of simplifying the tax code, improving economic growth, trying to fix some of the problems that have been looming since '86, of course, though notably passed on a partisan basis at the end of 2017. So as part of that design, as you can see from the chart here, we have a lot of expirations, both of business provisions that we'll get into in more detail tomorrow, as well as all of the individual stuff, right? So that includes the reduced tax rates, the widened tax brackets, the doubling of the standard deduction I mentioned earlier, the child tax credit expansion that started in 2018 is expiring, 109A is expiring. And then, of course, we also paired a lot of these tax cuts that I'm mentioning with what is known as base broadening. So eliminating some of these deductions and other exemptions that poke holes in the tax base to pay for partially some of these changes. And so that includes the $10,000 limit on state and local tax payments or deductions for state and local taxes paid. The tightened limit on home mortgage interest deduction is going away. There's a lot of other limits or suspensions of itemized deductions as well. The personal exemption was suspended, which was acts sort of like a standard deduction for individual members of a tax return. That's coming back. So a lot is unwinding here all at once, and that's what's, of course, motivating a lot of this. This, of course, on net, reduced federal revenue is scored by JCT by about $1.5 trillion, $1.7 trillion if you exclude deemed repatriation, which we'll get into tomorrow and on Wednesday. And of course, that's going to come with some revenue challenges if you want to make this permanent or extend some parts or all of it. Before we get into revenue real quick, of course, as Tyler mentioned, we did create a map to try to show the impact of this expiration. If anything, just to illustrate why folks find this so important to deal with in one way or another, right? Where, if you include business and estate tax changes, the number actually goes up from $1,700, Tyler mentioned, up to closer to $3,000 to extend everything as is. Big point here is this is just to preserve the status quo. So this isn't additional tax cuts on top. This is just to keep what we're currently doing right now, plus some of the some smaller business provisions that existed in 2018 and 2019. And so we've estimated about 62% of taxpayers see a tax increase. I think it's about 9%, if I'm recalling, see a tax decrease if there's an expiration, right? Because some taxpayers did see a net tax increase from the tightened itemized deductions and other changes to help pay for part of the law. So it's not universal, but it is a major portion of taxpayers will see a tax hike if this is not addressed in one way or another. And there's big geographic differences, right, as you can see here. And our tool can disaggregate all the different provisions on our website if you're interested in seeing that, because there are big differences depending on the provision we're talking about. So to get into revenue, I think this is one of the most, of course, biggest, most talked about areas when it comes to extension or permanence for the individual provisions of the 17 tax law, where we're sitting at about a $3.6 trillion revenue reduction relative to current law over 10 years. And of course, it goes up from there if you include business and estate changes, closer to $4.5 trillion. This is all relative to current law. So this is relative to the assumption that this all expires. There is, of course, a debate about using current policy baselines here in Congress, and that's maybe assuming that this underlying law is is extended, that the status quo is not having to be paid for, and that's how you end up with a much smaller $0 number. But of course, as JCT put it in a memo recently sent to, I think it was to Senate Finance, you do have the question of what is current policy is somewhat in the eye of the beholder of what you think that policy will be. So happy to get more into that in the Q&A, of course, because that is an important topic. Another important point here on revenue is that we do find dynamic effects. So a lot of the numbers you'll see, this $3.6 trillion number is a static number, meaning what is the 10-year revenue cost if we assume the economy is held constant? That's an important point. It's a historic number. It's a good sort of number to use if you have disagreements about economic effects, of course. But economic effects do matter, and they can have effects on income and payroll tax revenues in particular if the economy is smaller or larger from any given tax change. We actually have an economic model where we can quantify this and try to do this in the most rigorous, credible way possible. And we find that there is some dynamic effect that offsets about $400 billion of the 10-year cost, meaning you get $400 billion of extra revenue from individual income and payroll taxes that you otherwise wouldn't get because of the economic growth. But this, of course, this reduces the cost by 16%. That's not nothing, but it doesn't fully pay for itself. That's something we try to emphasize across the board, is that there are very few, if any, tax changes that you can make that pay for themselves. They can help as part of a broader package of offsets, but that's where we stand on dynamic effects. And of course, the other big debate on TCJA is on distributional effects, where this story here is interesting because I think it gives elements to both sides of this complicated debate. One of which, of course, is, and there's still a lot of misapprehension among the general public, where a lot of folks think they got no tax cut or actually a tax hike from TCJA, when most taxpayers did see, as demonstrated here and other estimates across the board, increase in after-tax incomes and a tax cut. So that is one important point that we find. Of course, dynamic effects can make this higher, right? And there's been a lot of claims about that, a lot of academic research that's being done even now to try to drill down on what was the impact on worker wages, who actually benefited, right? But as you see from the shape of this chart, right, there was, because higher earners are paying a lot of tax, of course, and earning a lot of income, as a portion of their incomes, they did see a larger benefit. And that creates, of course, a question of values and trade-offs of what you value in the distribution, who should be paying taxes. One point we've made, of course, is there's debates about fairness and who should pay their fair share. Very important questions, but one next step in the debate is, how do we measure that? What does that actually mean? What is the ideal baseline by which we determine the distribution of taxes paid? But regardless of where you stand on those issues, right, we try to measure at least the quantitative effects so that we have a similar baseline, because it's very hard to have a discussion or debate about the distribution of taxes paid when we don't even know or agree on what that underlying distribution is. So I think just having shared facts could be a helpful improvement to the debate. Maybe that's sort of obvious, but I think given where we are politically, that can be a helpful thing we continue to emphasize. So in the context of this, of course, we're finding that increased after-tax incomes across the board if we make the TCJA permanent. The numbers here on the right-hand side of the chart include business and estate tax changes, but you do see that increase across the board from income tax changes alone as well, which is the big bulk of it. And the last thing I want to mention here before getting into quick reform options and wrapping things up is, of course, the economic effects, which are, again, hotly debated. There's a lot of course, claims on, across the debate on where TCJA may land. The pandemic and the trade war and all the things that have happened since 2018 make it very hard to, in good faith, measure this. But we have, of course, in our modeling, tried to quantify the effects of extension as best we can. One important point is permanence really does matter. Temporary tax changes generally only affect behavior temporarily. I think that's fairly intuitive. That's what we find in our modeling. So what we've emphasized, and as Erica, my colleague, will get into tomorrow, it's really important to, from our perspective, you care about economic growth and certainty for taxpayers, to make, especially the tax provisions that are most pro-growth per dollar of revenue lost, that have the biggest impact for taxpayers in terms of simplification and supporting them, that we make those permanent and prioritize those, both from a stability perspective for taxpayers, for the government, and from an economic perspective. So this all assumes that everything is made permanent, and we do find that the lower rates and brackets do have an appreciable effect on economic growth if they're made permanent. They do have a large revenue cost, though, so that's the other trade-off here, is you have larger growth, larger effect on revenue. We also find, of course, that the base broadeners are not a free lunch. They do impact marginal tax rates, they do reduce incentives to work and invest, and they do cut some of the net growth off. Though on net, we do see a net increase in economic growth from both the individual provisions and the broader package if it were to be made permanent. Last thing I'll say, as I've hinted here, is that while growth matters, of course, it's not the only consideration. Considerations like simplification matter. We don't find a large growth effect from the standard deduction expansion, but that one actually did have a lot of benefits to taxpayers separate from considerations on growth. And the last thing here before we wrap up was I did want to mention at a very high level, we can get into this in more detail if you're interested, either here or offline, is we have all these expirations on the left on the various items we've been talking about. We also have, of course, the alternative minimum tax that's going to be coming back in broader force. A lot more taxpayers are going to be subject to that at the higher levels of income than they have been. What are some ideas on how we can deal with this? So we have a couple of papers that go into this in a lot of detail to demonstrate a couple of things. One is, if you care about base broadening and keeping rates low, that project is far from finished. And there, of course, historically, there's actually been bipartisan interest in doing that. And there probably could be again on trying to continue that project of areas where there can be mutual agreement to further broaden the tax base so that we can do this responsibly from a revenue perspective. It's hard, I know it's a hard lift in terms of politics and policy to do this, so it's we're eyes wide open on that. But you can, and we have demonstrated that if you were to change head of household provisions and try to simplify this filing status rules, for example, if you were to further limit or eliminate even state and local tax deductions and home mortgage interest deductions that accrue to the upper middle or the upper portion of the income distribution, that can help if not put a very large down payment, actually pay for a lot, extending a lot of the provisions, if not all of them. And we've demonstrated in the math that you can actually try to get close to revenue neutrality while also trying to at least preserve the structural distribution, right? I think that's the other consideration. It's hard to get all of these done at the same time. As Tyler mentioned, trade-offs are central here, but it can be done. It's just going to be a hard lift. We have all the details in our website if you're interested. And there are several other ideas that generally are net tax cuts that we think could be good from an economic growth and simplification perspective. One, of course, is inflation adjustments to either the CTC, other broader rationalization and simplification of the credits, as I mentioned earlier, could be done on a bipartisan, revenue neutral basis. There's been some ideas that float around the hill on that for years. We're also big fans of universal savings accounts, which basically is trying to provide 401k or IRA-like treatment to a broader set of savings, which could be very helpful. There have been experiments done in Canada and the United Kingdom in particular that have been very successful. That's something that we've been doing a lot of work on. There's, of course, broader reforms to the tax treatment of businesses, which we'll get into tomorrow in more detail, particularly for the 198 deduction, which is very complicated. Of course, it's costly, but there's, of course, a lot of political debate on this and making sure we're not surprising businesses by allowing this to expire or increasing their tax rates. But there are probably, sensible reforms we could do there. And of course, we also have broader ideas on how to completely reform the tax code, right, to make it more competitive, simple, and pro-growth beyond this. So there really is a range of options here, and we are, of course, headed down a particular vehicle and track here. And if anything, I'll just leave it off on a more optimistic note before wrapping up, is this isn't, of course, this is a major shot and opportunity to revisit this. It's not the only one, and it's not the last one. I'm sure we'll have opportunities, hopefully, in the next decade and beyond to revisit this. We have seen that pattern, of course, with control changing and, a very polarized set of ideas where the middle or, shared set of ideas is shrinking, but that's not an impossibility that we might see that again, sort of continuing that legacy of what we saw in 81 and 86, far from perfect packages, but much more sort of a collaborative effort there. So hoping to set that intellectual groundwork to continue these conversations, even in the midst of deep disagreement. So just to wrap up, a little bit of recap here, of course, just emphasizing the broad structure here on the tax base and rate for individual income taxes, right, that we do have a marginal tax rate structure. We have a progressive structure. We didn't get into that in too much detail in this session, but our tax code is quite progressive. Some folks may not see it more progressive, right, and that's going to be another part of that distributional discussion. But generally speaking, we are seeing a progressive marginal tax rate structure in the individual income tax code that's dominated by, other exemptions, deductions, and exclusions for your taxable income. And that gets into the base side of things, right? We're trying to tax a wide range of income under the code. And of course, we have these family and worker tax credits that are beneficial, but are very complicated and are ripe for reform opportunities amidst other ideas. And of course, we are continuing to, Tax Foundation, engage very heavily on TCJA expirations. One thing I will mention, as Tyler mentioned, is we do have a macroeconomic model that can produce revenue estimates, economic estimates, distributional estimates, all sorts of numbers. So if any of your bosses or colleagues or anyone, if you have interest in ideas for reform, policy ideas, feel free to reach out to us directly and we can work with you, give you ideas, give you numbers. Happy to work with you anytime on as we can be helpful at Tax Foundation.